Reasons why an audit is considered necessary for what? For limited liability companies. Limited liability companies. That is the question. Reasons why an audit is considered necessary for limited liability companies. So I'll give you an opportunity to try. What do you think? So that shareholders can know how their company is going on. I was explaining a point before coming to Vincent's point on what was it? Say that shareholders can know how the company is going on. So that shareholders can know. Someone says so that shareholders can know how the company is going on. It's important, candidates, to note that public entities are owned by the public as opposed to the private entities. We began by reading private companies are not required by law to have their financial statements examined. However, all public entities are required by law to have their financial statements audited. Public entities are owned by the public. So one reason why it's mandatory for public entities to be audited is to protect the interests of the public. Protection of public interest is one reason why an audit is necessary for limited liability companies. One, protection of public interest. Protection of public interest, to protect the interest of the public. Public entities often have numerous stakeholders. They have numerous stakeholders, including what Vincent says here, regulators, right? Shareholders, whose interests may not be directly involved in the day-to-day management of the company. Okay? The interests of the shareholders and other stakeholders may not be taken into account in the day-to-day operations of the company, and therefore an audit provides an independent assessment of the financial statements, ensuring transparency, accountability to all the external parties or stakeholders. You understand? There are many people who have an interest, or parties that have an interest, in public limited companies, in limited liability companies, shareholders, creditors, members of the public, and so on. So by having an independent assessment of financial statements, then transparency and accountability can be attained. You understand? So that is one point. Then someone says here, for the purpose of income tax, Irene says to ensure that the costs incurred are accurate and can be traced. So that to ensure that the costs incurred are accurate. So as to ensure the costs incurred are accurate. That point, Irene, is close to close to we are talking about costs. I would look at it from the perspective of internal controls. Audits can improve or can lead to improved internal controls, other than just saying to ensure that the costs incurred are accurate and can be traced. That, Irene, can only be made possible if the company has proper, effective internal controls. And that is one objective or reason for having an audit. Audits can lead to improved internal controls. So to be more accurate, you can say improved internal controls. Improved internal controls. The audit process often identifies weaknesses in internal controls, leading to recommendations for improvements. The auditor at the end of the audit may come across or may realize or discover that the company has weak internal controls. Then at the end of the audit, the auditor may give recommendations on how to improve the internal control system. And that can enhance the company's operational efficiency and reduce the risk of financial misstatements. So Irene, your point is closely related to improved internal controls. Now, related to internal control system, we have number 3, deterrence of fraud and errors. Is to deter fraud and errors, to prevent fraud and errors. An audit of financial statements can prevent fraud, can deter errors. The knowledge that an independent audit will be conducted can deter the management, can deter the accountants from engaging in fraudulent activities. All right? You understand? The fact that the accountant or the management know that there will be an independent examination of the financial statements, that there will be an expert coming, an external person or entity coming in to audit. And I began by explaining that an audit is an independent examination of the financial records. So the knowledge that an independent audit will be conducted, that in itself can deter, can prevent the management, can prevent the accountants from engaging in fraud or making material errors in the financial statements. So that is to say that an audit acts as a check on potential misconduct. It acts as a check on potential misconduct. Do you understand? You understand? That is why it is mandatory for limited liability companies to conduct audits. Is that clear? Any other point? Someone? Irene says, it gives an assurance to investors that the financial statements are the true reflection of the company performance. All right? That is true. It gives an assurance to investors, to potential investors. Because those who have already invested in a company are shareholders. So it gives an assurance to potential investors that financial statements are the true reflection of the company performance. That is to say that, in other words, that is to say that an audit enhances credibility. It enhances credibility. That is to say also, in other words, that an independent audit enhances credibility and confidence. It gives the assurance to the users. So, Irene, instead of just limiting your answer to the investors, talk about users, investors being one of the users. So an audit of the financial statements enhances or increases the credibility and confidence in the financial statements. Audited financial statements are considered more reliable and trustworthy than unaudited ones. Because you see, if an independent auditor comes into the company and examines the records and gives an opinion and maybe in his report gives a positive opinion, such financial statements are more credible, are more reliable than ones that have not been audited, because they increase credibility and can attract investors. Such statements can attract lenders and other stakeholders who may rely on accurate financial statements. So I think that is a good point. That is a strong point. It gives assurance, confidence. It gives confidence. It gives assurance. It improves credibility. Then the statements become more reliable. Then Irene says auditing is a requirement of the law. Auditing is a requirement of the law. So why does the law make it a requirement? Why does the law make it a requirement? When you say it is a requirement, you are repeating what the root says. That, however, all public companies are required by law. Why are they required by law? 1, to protect public interest. 2, to improve internal controls. 3, to deter fraud and errors. 4, to enhance credibility and confidence. All right. Vincent says it gives assurance that accounting principles and procedures are accurately followed by management or public companies. Now, Vincent, what you have done, you have in a way defined auditing. Auditing gives assurance that accounting principles and procedures are accurately followed by management of public limited companies. You are defining auditing, which, to put it in other words, is the systematic and independent examination of financial statements and records and relevant information of an organization to determine if they are fairly presented and comply with applicable financial reporting frameworks. So you have defined auditing. What you have done is to define auditing partly. Give assurance that accounting principles and procedures are accurately followed by management. You've just defined it, but tell us why the auditor should come in and determine if the management has followed, the way to use your words, has followed accounting principles and procedures. Okay? And you are right. That is, I'm not saying it's not a point, Vincent. That is a point. Compliance, to put in other words, you are saying is to determine compliance. Instead of just limiting it to principles and procedures, accounting principles, we can summarize all the regulatory requirements and say compliance with legal and regulatory requirements. Is that clear, Vincent? That is a good point in relation to compliance, not just giving assurance, but also giving assurance. It is to give assurance that the entity has complied. You get the difference. The purpose for conducting an audit is so that the auditor can give assurance to the users of the financial statements that the company or the management has complied with legal and regulatory requirements. Because candidates, auditing is not limited just to the examination of financial statements. No. It is to the financial statements, it is not just limited to the quantitative aspect. If, for example, the ledgers have been recorded accurately, or the trial balance has been extracted accurately, or accounting principles like accrual principles have been followed, materiality has been adhered to, apart from the accounting principles that Vincent is talking about, the auditor also checks compliance with legal and regulatory. Compliance with legal and regulatory requirements. Companies are required to comply with certain rules, laws, and regulations. For example, we have the Companies Act, that is a legal requirement. We have the Capital Markets Authority regulations, those are regulatory requirements. So the auditor has to check if the company has also complied with such legal and regulatory requirements. And many jurisdictions mandate audits for public entities to ensure compliance with financial reporting regulations and other legal requirements, because that then helps maintain the integrity of the capital markets and protect investors. You understand? I know you are financial reporting students. Companies, you recall, are required also to, apart from providing the financial statements, companies are required to make certain disclosures, to disclose, to give information over and above the financial information. You understand? Yes. So, Vincent, that was a strong point. Now, candidates, another reason for conducting, there are many reasons, but amongst the many reasons, the sixth one is in relation to identifying problems early. Audits can help a company detect problems early. We can say early identification of problems. Early identification of problems. Audits can uncover potential problems or risks early on, allowing management to take corrective action before they escalate into major issues. And in a way, that is a proactive approach which can safeguard the company's financial health and sustainability. Because we recall, at the end of an audit, the auditor is required to give an assessment. The auditor, in the process of examining the financial statements, the financial records, he may come across potential problems before they escalate into major issues. And that is the reason why an audit of limited liability companies is mandatory.